Hello class, this is chapter 6 video lecture. We're taking a look at inventories. So we looked at cost of goods before, and we're looking at the actual sales and how to account for inventory. So there's several learning objectives to describe the importance of control over inventory. Describe 3 inventory cost flow assumptions and how they impact the income statement and balance sheet. Determine the cost of inventory under the Perpetual inventory system using LIFO, FIFO, and weighted average cost methods. Determine the cost of inventory under the periodic system using the FIFO, LIFO, and weighted average cost method. Compare and contrast the use of the 3 inventory costing methods. See which one is the best for the situation. Describe and illustrate the reporting of inventory in the financial statements. Describe and illustrate the inventory turnover and the number of days sales in inventory in analyzing the efficiency and effectiveness of inventory management. And describe and illustrate the estimation of inventory using the retail inventory and gross profit methods of inventory costing. 2 primary objectives of control over inventory are as follows: safeguarding the inventory from damage or theft, and reporting inventory in the financial statements. Controls for safeguarding inventory begin as soon as the inventory is ordered. The following documents are often used for inventory control: purchase order, receiving report, and vendor's invoice. The purchase order authorizes the purchase of the inventory from an approved vendor. The receiving report establishes an initial record of the receipt of the inventory. To make sure the inventory received is what was ordered, the receiving report is compared with the purchase order. The price, quantity, and description of the item on the purchase order and receiving report are compared to the vendor's invoice before the inventory is recorded in the accounting records. Recording inventory using a perpetual inventory system is also an effective means of control. The amount of inventory is always available in the subsidiary inventory ledger. Controls for safeguarding inventory should increase security measures to prevent damage and customer or employee theft. Some examples of security measures include storing inventory in areas that are restricted to only authorized employees, locking high-priced inventory in cabinets, using two-way mirrors, cameras, security tags, and guards. The physical inventory or count of inventory should be taken near year-end to make sure that the quantity of inventory reported in the financial statement is accurate. After the quantity of inventory on hand is determined, the cost of inventory is assigned for reporting in the financial statements. Most companies assign costs to inventory using one of 3 inventory cost flow assumptions. Cost flow assumptions, so FIFO is first in, first out. Purchased goods, sold goods, that uses cost flow in order in which the costs were incurred. 2 is cost flow is in the reverse order in which the costs were incurred. Inventory, that's last in, first out. Purchased goods, sold goods. Cost flow as an average of the costs, weighted average costs, purchased goods, and then they weigh the average. So notice right here is first in, first out. This one's last in, last out, or last in, first out, and then they just weigh the last method, or the last method is weighed. So assume that 3 identical units of merchandise are purchased during May as follows: May 10th, purchase 1 unit at $9. May 18th, purchase 1 unit at $13, and May 24th, purchase 1 unit at $14. So the total is 3 units, cost is $36, average cost per unit is $12, 36 divided by 12 units. Let's see, did that move? Inventory, so assume that one unit is sold on May 30 for $20, depending upon which unit was sold. The gross profit varies from 11 to 6, and the ending inventory value varies from $27 to $22. So it says, here's what it looks like. So our gross profit, our ending inventory, 13 plus 14, 9 plus 14, May 10 units sold, May 18 units sold, May 24th unit sold, and the ending inventory as such, right on that column. Under the specific identification inventory cost flow method, the unit sold is identified with a specific purchase, and the ending inventory is made up of the remaining units on hand. Because the specific identification inventory cost method requires each inventory unit to be sold separately or separately identified, it is not practical for most businesses to use. Under the first in, first out, or FIFO inventory cost flow method, the first units purchased are assumed to be sold, and the ending inventory is made up of the most recent purchases. Under the last in, first out inventory cost flow method, the last unit purchased are assumed to be sold, and the ending inventory is made up of the first purchases. Under the weighted average inventory cost flow method, sometimes called the average cost flow method, the cost of the unit sold and ending inventory is weighted average of the purchase costs. The purchase costs are weighed by the quantities purchased at each cost, thus the term weighted average. So here's an inventory costing method, FIFO method. Okay, so here it is. Sales 20, cost of goods 9. So our profit was $11. So on our balance sheet, inventory 13 plus 14 equals 27. Inventory is 27. So here's a LIFO method. So 20 minus 14. Notice the difference. That's 14. That's 9. So the most recent one was $14. The first purchase was $9. So that one's FIFO, first in, first out. Last in, so you take the cost of goods for the last one that came in, and then for the weighted average, 9 plus 13 plus 24 divided by 3 is 12, so we put 12 as our cost of goods. So just keep that in mind. Those are the differences. But not only that, but look at the gross profit. Your gross profit is higher whenever you do FIFO because it's $11. Your gross profit is $6, so it's less whenever you do FIFO or LIFO. Now, your weighted average, your gross profit is between 6 and 11, not necessarily perfectly between them or the median, but it's actually going to be $8. So that's, I mean, you just, depending on how you want to expense them, that's what you have to go with. So for purposes of illustration, the data for 127B are used as shown below. We'll examine the perpetual inventory system first. Inventory 1,000 units at $20. Sale price $30 per unit. 700 were sold. Purchase 500 units at $22.40. Sale at $30 per unit for when units sold were $360. Another sale of 240 was made for $30, and lastly another purchase of 600 for $23.30. So here's what this will look like. When the FIFO method is used in a perpetual inventory system, costs are included in the cost of goods sold in the order in which they were purchased. This is often the same as the physical flow of the goods. For example, grocery store shelves shelve milk and other perishable products by expiration dates. Products with early expiration dates are stocked in front. In this way, the oldest products' earliest purchases are sold first. So here's what this would look like. This is the example we just talked about earlier about the number of units that was sold and purchased. So account receivable, if it's account receivable, this was sold on credit. So our cost of goods was $1,400, $1,400. So whenever we do a sale, we always have to, we're expensing this $14,000 to our income statement, and our inventory is coming off of our balance sheet. So we're pulling $14,000 out of inventory. And then right here we made a purchase in inventory, and we made it on a payable. Usually you can tell if we sold something or bought something. So account receivable. So we sold $10,800 on an account, so that goes to sales. That one also was sales. So now we're costing out those units that we sold. Then we sold some more for $7,200. And there's our cost of goods. So every time we sell something, we always have to cost it out. Then our inventory, we purchase some more inventory. So our total cost of goods sold will be $26,720. And then our inventory on January 31, our ending balance is going to be $18,460. Don't forget those are dollars because each of these are priced out. And our quantities are there. Usually you will be able, this quantity on hand will be right there as well, physical count. So the ending balance on January 31st, I just said this, 18,460. This balance is made up of 2 layers of inventory as follows. So 200 at 22.40 and 600 at 23.30. So then that's the total right there. And then there's our quantity. When the LIFO method is used in a perpetual inventory system, the cost of units sold is the cost of the most recent purchase. LIFO method was originally used in those rare cases where the units sold were taken from the most recent purchase units. However, for tax purposes, LIFO is not widely used, even when it does not represent the physical flow of units. Okay. So here's the LIFO method. Again, these are the same. These are very similar to what we did. Only difference is whenever we do this, we take we use the most recent ones first and then work backwards. So FIFO, we did the first ones and went down. LIFO, we go from the bottom, so the 23, and then we go up and take care of those expenses, or no, take care of that inventory first. So our cost of goods is $27.20. Our ending inventory will be $17,980. Again, this is LIFO $17,980, and look at this one though, $18,460. So if you look at that $18,460 is this one. This one is the FIFO, but when we look on this one, this is $17,980. So there's a difference in your inventory, and you have to go by your layers. So this is just a checkup. Let's see. Okay, so we purchased 40 units at $5. We sold 30 units. We purchased another 70 at $7. Sales of 36 units. And they should tell us how much we sold each one for, but they don't. So the company uses first in, first out method, and then last in, first out. So let's take a look at what that'll look like. So here we go. Cost of goods. These are the purchases that they just looked at right here. So quantity 40, this was the purchase, so this cost us $200. Then we sold them, we sold 30. Although notice how we didn't have how much it cost and how much revenue we made. This is just looking at the inventory. Okay. Anyway, so $382 will be our total cost of goods sold, and our inventory will be worth $308. Okay. Here's the other method. Now notice this one is 382 and 308. So then over here is 402 and 288. So that's one of the areas that we need to look at. So if we're costing things out, we typically want your cost of goods, your expenses to be down quicker, because then you're expensing it, and then that brings your bottom line. It brings your bottom line down, but you want it. It just depends, honestly. But our inventory, how much inventory on our balance sheet will be lower than this method right here. Okay, so this is the FIFO, this is the LIFO. Okay, so those are things that you need to be aware of. Which method has a greater impact on the income statement, which on this one, 402 is larger than 382. That's why LIFO has a greater impact on your income statement. And then 308 versus 288. So 308 has a greater impact on your balance sheet. So your inventory is, sometimes they say it's overstated, or sometimes they say it's understated. So it just depends on how you look at that. So weighted average cost method. When the weighted average cost method is used in a perpetual inventory system, a weighted average unit cost for each item is computed. each time a purchase is made. This unit cost is used to determine the cost of each sale until another purchase is made and a new average is computed. This technique is called a moving average. Okay. So these are the same purchases. So what we did was what it did was it lined it up so you could compare them. The cost of goods ending is $26,900 and $18,280. Typically, the weighted average will be between your LIFO and FIFO. So this, if we went back and looked at this, I think one was $17,980 and one was $18,840 or something like that. So then $18,280 is about the middle because we averaged all of them. Okay, so this one is asking us to look at them, looking at the weighted average. Again, this one, this is the same example when we looked at, remember when I talked about 308 versus, I think it was like 298 or 292 or something like that. Well, this one is 297 and this one is 393. So our cost of goods sold is 393. So it's just comparing them. It's looking at the three methods in essence side by side, okay? So when the periodic inventory system is used, only revenue is recorded each time a sale is made. No entry is made at the time of the sale to record the cost of goods sold. At the end of the accounting period, a physical inventory is taken to determine. So keep in mind, all of the cost of goods are done at the end, okay? These other ones on here, look at this, the cost of goods is sold is done whenever it happens, okay? So keep that in mind. Keep in mind, this is perpetual. Notice that's perpetual. That means that it's ongoing. So that now we're taking a look at the other side, which is the periodic, and that's when it's done at the very end, like I was saying earlier. At the end of the accounting period, a physical inventory is taken to determine the cost of the inventory and the cost of the goods sold. Like the perpetual inventory system, a cost flow assumption must be made when identical units are acquired at different unit costs during a period. So first in, first out. Okay, beginning inventories purchases of item 127B in January as follows: inventory of 1,000 units. So this is how many units we have, and that's our cost of our inventory. Okay, let's see. So it says the physical account on January 20 shows that 800 units are on hand. The cost of 800 units in the ending inventory. So our most recent is 600 units, 200. Don't forget, only 800 were left. So we with our first in, so we have to go with our first purchases of our first ones in, our first ones out. So then our 2330 and 2240. So we look at that 2320 and 2240. So that's where we're looking at that. So our cost of goods at the ending will be 18,460. And then don't forget, this is with the periodic. So now first in, first out again. So beginning inventory is 20,000, purchases of 25,180. Cost of goods available for sale in January at 45,180. Our ending inventory is 18,460. So our total cost of goods sold will be 26,720. So this is a formula that you're going to need to know. So make sure you have this and you see how this is. Beginning purchases, cost of goods available. This is our when we add those up, and our ending inventory, and the difference between those would be our cost of goods sold. Okay, so keep that in mind, and this will help you as well when you answer some of the questions. First in, first out, flow of costs. So again, this is kind of schematically what would happen, okay? We purchase it, it goes to cost of goods available for sale, cost of goods sold. So this is kind of showing what's up here. So then January we had 500 units, but the thing is, we only have 500 units. So when we have a sale, we only use 300. We have to use 200 of another one as well. Okay, so that's kind of showing, that's what this is showing right here. Assume again that the physical count on January 31 shows that 800 units are on hand. The cost of 800 units in ending inventory on January 31 is 16,000, which consists of 800 units from the beginning inventory at a cost of $20 per unit. Last in, first out method. Again, this is very similar. beginning inventory was 20,000. Purchases, the two purchases for 25,180, 45,180. Ending inventory is 16,000. So our cost of goods sold is 29,180. Okay. Again, this shows the breakdown, but notice this is a little bit different because this is last in. So the last one ends. The last items in or units in are going to be the ones that are going to go out first and expensed out. Okay, so that's what this is showing. If purchases are relatively uniform during a period, the weighted average cost method produces results that are similar to the physical flow of goods. The weighted average unit cost is determined as follows. Weighted average, total cost of units available for sale divided by units available for sale. Okay, total cost divided by units available. What is the average cost per unit in the ending inventory? So this is how we would do it. So 45,180 and there's 2,100 units on hand. So it'll be 2151 per unit, and that's rounded. So then that 2151 per unit, that's what we're going to look at. So our beginning is 20,000. Our purchases is 25,180. So our cost of goods available in January is 45,180. Our ending inventory was 17,208. So our cost of goods sold was 27,972. But keep in mind, this number is the number that's going to be between LIFO and FIFO. So the weighted average is kind of right in the middle. And here's the weighted average. Notice how this is balanced up here. LIFO was up here. I think FIFO was down here. So these arrows is more balanced approach right here. Okay, so this is another example. So we're going to have to look at it with FIFO, LIFO, and then weighted average. And this is inventory purchases. So we're going through and looking at this 40 units with 2310. So here's what it looks like. Our cost of goods sold is 1318. Right here was 1418. Now notice first in, first out is always lower. Last in, first out is always higher for our cost of goods sold. Okay, and our weighted average is always going to be in between the high and the low. So just keep in mind, that's kind of why we're looking at them side by side or vertically. Comparing inventory cost methods, a different cost flow is assumed for FIFO, LIFO, weighted average. As a result, the three methods normally yield different amounts: cost of goods sold, gross profit, net income, ending inventory. Note if the cost price remain the same, all three methods would yield the same results. However, cost or prices normally do change. So that's, whenever you buy something, it usually, the price is not stagnant. The price is always changing. Comparing inventory cost methods, okay, and this is looking at gross profit. Gross profit with first in is 1280. Weighted average, again, is right in the middle. Last in is definitely lower. Your profit, typically if you're on the business side and you're making money, you're going to want a higher gross profit, okay? But that's where you look at this, and I kind of mentioned this earlier. Your cost of goods sold is going to be higher with your last in, first out. So then that brings your income statement. Your expenses increase your expenses, but then your gross profit goes down. So that's typically people go with first in, first out. But it just depends on the situation. That's why there's a weighted average, because sometimes your products in your inventory that you purchase doesn't change, so you go with the weighted average. So it's just going to depend on the business that you work for or the business that you own. Effects of change. Again, this is what I had kind of talked about. Cost of goods sold. You can take a look at this, but this kind of explains what I've been talking about whenever you compare them side by side. FIFO reports higher gross profit and net income than LIFO when cost prices are increasing. However, periods of rapid rising costs, inventory that is sold must be replaced at increasingly higher costs. In such cases, larger FIFO gross profit and net income are sometimes called inventory profits or illusionary profits. Keep in mind, if you do this, whatever method you decide to do not switch in between methods. Stick with FIFO, stick with LIFO, but don't be switching back and forth, because that's whenever you get audited, you'll get some red flags and that won't be good. So stick with one method. During the period of increasing costs, LIFO matches more recent costs against sales on the income statement. LIFO also offers an income tax savings during periods of increasing costs. This is because LIFO reports the lowest number of gross profit and thus far lower taxable net income. Okay, don't forget that's an important too. Whenever you have lower gross profit, you're paying less income, taxable income. So whenever you have a larger gross profit, then you're going to have your taxable income will be lower. However, under LIFO, the ending inventory on the balance sheet may be quite different from its current replacement costs. The weighted average cost method is, in a sense, a compromise between the FIFO and LIFO. The effects of cost, price, trends is averaged in determining the cost of goods sold and the ending inventory. So cost is the primary basis for valuing reporting inventories on the financial statement. However, inventory may be valued at other than cost in the following cases. The cost of replacing items in inventory is below the recorded cost. The inventory cannot be sold at normal prices due to imperfections, style changes, spoilage, damage, obsolescence, or other causes. So LCM is the lower of cost or market, is used to value inventory. Market is used in lower cost or market, or is the net realizable value of the inventory. Net realizable value is determined as follows. Net NRV, estimated selling price minus direct cost of disposal. Direct cost of disposal includes selling expenses such as special advertising or sales commissions. So original cost is $1,000, estimated selling price is $800, estimated selling expense is $150. The greater the LCM, the market value of inventory is $650, compute as follows. So 800 minus 150 is 650, thus the inventory would be valued at 650, which is the lower of its cost of $1,000 and its market value of 650. The lower cost of or market method can be applied in three ways. The cost, market price, any declines could be determined for the following: each item in the inventory, each major class or category inventory, total inventory as a whole. The amount of any price decline is included in the cost of goods sold. This in turn reduces gross profit and net income in the period in which the price declines occur. This matching of price declines to the period in which they occur is the primary advantage of using the lower of cost or market method. Okay. So 1025 is a price, market value is 950. Since there is a difference, item A is 950 per unit, 950 is under the lower of cost or market, so you would go with 950. The following is okay, so this is just explaining in more detail the market declines under each approach would include in cost of goods sold. Applying the lower of cost or market method on an item by item basis always gives the lowest value for inventory. Conversely, applying the lower of cost or market method to the total inventory always gives the highest value for inventory. Okay, so here's LCM for these. So this is taking a look at class 1, class 2, and just breaking that down. So go ahead and take a look at that in your textbook and compare them. 1570, 15412, 15472. Okay, so keep that in mind. All right, so this is just going through and taking a look at in more detail, and this is the cost market. LCM is 1680, because notice that when you compare them, cost is that, so your market is lower. Your cost is lower, so you're going with the cost. Your market is lower, so you're going to go with the market. Okay, so lower of cost or market. Inventory is usually reported in the current assets section of the balance sheet. In addition to this amount, the following are reported on the balance sheet or the company notes. The method of determining the cost of inventory: LIFO, FIFO, weighted average. The method of valuing the inventory: cost or lower of market. Okay, so merchandise inventory. That's just showing where it goes. Any errors in merchandise inventory will affect the balance sheet and income statement. Some reasons that inventory errors may occur include the following: physical inventory on hand was miscounted, costs were incorrectly assigned, inventory in transit is incorrectly included or excluded, consigned inventory was incorrectly included or excluded from inventory. So errors often arise from merchandise in transit. Shipping terms also kind of confuse things. FOB shipping point, FOB destination, which we took a look at in the previous chapter, but those also get confusing and can cause errors. Errors, consigned inventory, shipment, consigner, consignee. So those kind of impact as well. Any unsold merchandise at year-end is part of the manufacturer or consignor's inventory, even though the merchandise is in the hands of the retailer or consignee. So sometimes, like if you purchase stuff, the consignor is the one that, you know, they return the title of the goods, and the consignee is, you know, that's where you're shipping it and being sold at a store. So these are the effects. Beginning inventory, you know, and go ahead and go through those. If beginning inventory is understated, cost of goods is understated, gross profits overstated, net income is overstated. So take a look at those in your book as well. Effects of inventory errors to your income statement. So if it's low, the next year will be high. If it's high the next year will be low. That's in essence what this is talking about. Again, this is errors on the balance sheet. And let's see, these are the overstatements and reversals, how to correct them. So go through and take a look at those. And let's see, here's an example. Over the next year, under, over the next year. Gross profit is over, and then it'll be under the next year. So your income will be over, and your income will be under the next year. So keep those in mind as well. Excuse me. So this is inventory turnover. Okay, just taking a look at your inventory and seeing if you have enough or what's going on, and see if you have risk. So inventory turnover is cost of goods divided by average inventory. This is an important number whenever you carry inventory on hand when calculating to see if you're good to go with that inventory, or if you need to be moving that inventory, or if inventory is just staying in your system and not moving. And you got to make decisions about what you're going to do with it. Maybe you sell it at a discount or at a premium, things of that nature. For example, nappy alfalfa from last year isn't selling, so they put a sale on it to get rid of last year's inventory. So decisions like that have to be made, and you use this number right here, inventory turnover, to see what you're at. So here's an example of what's going on. 5.9, 5.9, 5.1. These are your inventory turnover. There's your average inventory, and comparing them and looking at them, cost of goods sold, and you take a look at that and try to make decisions. Number of days sales in inventory, average inventory divided by average daily cost of goods. So this is taking a look at number of days this is staying in your system. So this is staying in your system for 83 days, 85.7 days, 85.5 days. Average daily cost of goods, I'm sorry. Here's your average inventory. So this has been in our system for 61.5 days, 61.6 days, 71.7 days. So something's up here. So adjustments were probably made there. That's kind of high compared to year 3 and year 2. Best inventory, Best Buy 5.9, Whole Foods 21.2, number of days 61. But notice this is food too, so you can't compare Whole Foods to a Best Buy. You probably compare Best Buy to, I'm not too sure of another, maybe Sears, something like that. But these are kind of hard to compare to each other. All right, let's see. So I think we kind of covered this already. Retail inventory method of estimating inventory. Okay, so these are just, go through these. These are appendix. Go through these. There aren't very many questions regarding these. Determine inventory by retail method. Go ahead and go through this as well. But it's just going through step by step for merchandise available for sale. Gross profit method of inventory. So go ahead and go through that. Let's see. Estimating inventory by gross profit method. So this is an estimate, and it's 30% right there. So that's kind of the whole chapter in a whole. So remember LIFO, FIFO, and weighted average, and then comparing them, the benefits of using each, and first in, first out, last in, first out, and then the weighted average. So go through. I'll post the homework as well. Thank you. I hope these videos help.